Folks, one of my biggest takeaways from Jonathan's event in Vegas is just the sheer opportunity that is coming in the commercial space. Whether you want to be a general partner, a limited partner, or someone like Olivia and I buy our own stuff, I was encouraged by the acknowledgement of all the opportunity coming, and it helped me expand even what I thought was possible coming forward. So, Jonathan, I think it's very clear that the commercial market, debt, equity, is going to have some pain. You and I have warned for at least a year about the dumb, stupid, idiotic deals being get done, the over leverage of bridge debt. We have warned about this, but coming out of your event, I'm excited because it's all coming true, and we're gonna get some shots at some interesting assets, I think.
Yeah, absolutely. I mean, we've talked about this in other segments. We've talked about this before, but this rise in interest rates has just, I mean, you know what this is? This is Warren Buffett's tide going out, right?
Exactly.
This is the tide going out. You see who's skinny dipping, right? And not enough people prepared for the tide to go out. And those people who are not prepared are going to wind up losing those assets, and those are opportunities for everybody else. But it's not like these are going to be hanging on trees for you guys, right? It's not going to be easy necessarily, because the way that the capital markets always work is, the best time to buy deals is when it's hardest to get the money. And those two things are intimately related, right? Because the reason it's hard to get the money, is that's why the prices are so good. So the people who are in a good position, who have cash or have access to cash or can partner with other people and pool cash together, are the ones who are going to be able to take advantage of these opportunities. So they absolutely are coming, though, because it's just a matter of time in commercial space anyway. Debt resets every 5 to 10 years. You've got to refinance. You have no choice. Banks are.
I think it's even going to be shorter than that, because one of my takeaways, it's the bridge debt. It's the
Oh yeah.
stupid deals from 21 and 22 that have two years, right? It's like right in front of us, I think.
Yeah, no, absolutely. I mean, and not just the bridge. I mean, the bridge debt is obviously some of it, right? And some of the bridge debt, I mean, the typical bridge debt that I saw was 3-year term with 2-year extensions, right? So it could be up to 5 years. There is some shorter term bridge debt, but most people were at least like conscious enough to know that they needed more time.
Yeah, that's too short.
Yeah. So, but I mean, I know like for flippers and stuff, they're definitely shorter term, right? So
for sure.
And I think there's going to be some opportunity there for folks in the single family space to pick up broken flips, or flips where they just couldn't get it done and they can't refinance now. And so there's going to be opportunity there for sure. But I think you're right. The bridge debt is a problem. But even if it's not bridge, in commercial lending, we've said this before, it's not enough just to be paying your loan, right?
Exactly.
Your asset has to be performing with enough cushion for for the lender to feel comfortable.
So, Jonathan, let me throw this scenario at you, because you're in this a lot more than I am. So let's pretend it's 2019 in sub mid-tier market, maybe a market you were buying in when you built your big portfolio. So you buy at 2019 prices, you have 2019 interest rate, so it's before everything fell through the floor. It's now 2024 and you had a 5-year term. The asset's probably up in value, I would guess.
Yeah.
But I don't know how much. And the interest rate today might be on par with 2019. Kind of where, but cap rates probably are different. I don't know. Kind of play that out.
So if you bought in 2019, so first of all, you've got another year at least to go. Sure. So 5-year debt, right?
Yep.
If you bought in 2019, you're probably in a relatively decent position right now, because let's assume it was a value add. You had your opportunity to increase your rents. Your NOI is higher. So what's going to happen is you're probably going to be able to refi that loan. You'll probably be okay. Maybe you'll have to add a little bit of capital, but most likely you'll be okay. But you're not doing cash out. You're not, you're not giving your investors a big liquidity event. That's probably not happening, but you're fine.
You're okay.
You're not going to be in you're not going to get foreclosed on.
But you and I both know there's very few owners or partners that kept the 2019. Most of those folks my opinion only, you can agree or disagree, is they took the opportunity to sell partial value add in 21 or 20,
Well, yes, a
exited
lot.
huge, and that
Yes,
deal is now bad.
yes, a lot. That is definitely true. There are definitely people who took advantage. So bought in 2019, who took advantage of the crazy prices in
Got
2021.
lucky on timing.
Yeah, sold that and then turned around and put the money into something else at a high valuation, right? So
Exactly.
it's, you know, it's like, you know, you can make money, make money, make money, make money, and then you can
Bam.
lose it all because, you know, the market changes on you if you never take the chips off the table, right? So
Exactly.
there are lots of people who just continue to reinvest. But I think but in that scenario, that 2019
Yep.
scenario, if you didn't refinance, if you
Yeah.
didn't sell, if you didn't, you know, or if you sold and you just took the chips off the table, like Brian Burke,
Yeah.
you're you're fine, right? In
Yeah.
any of those scenarios. The issue is the people who bought in 2021, 22, when cap rates went to, you know, even lower than previous historic lows.
Yeah.
And the only way to make deals work was to do variable rate debt, right? And because you get a few extra basis points of interest rate because it was variable rate debt, they did or they didn't buy a rate cap. Even if you did buy a rate cap, your interest rate has gone up now and hit the cap. And in a lot of cases, what that means is that you still may be paying your debt service and you're fine, but you're not, your NOI, now that you know, the denominator has grown. No, the other way around, right? Well, anyway, it doesn't, whatever the math is, whichever it is, the fractions, the fact of the matter is that now your debt service has grown, right? So the
Yep.
amount of money that you have to pay each month has
Yeah.
grown relative to your NOI, which means that you don't have the coverage that the bank wants to see to feel safe. So a lot of
Exactly.
those people are being thrown into what's called cash management right now, where the bank essentially takes over your bank accounts and it becomes a lot more difficult to operate your property. You know, the bank is like, basically all the money is, they're giving you a budget to operate on, but anything else that happens, if you have a broken something, you need to replace a roof, you've got to make a capital call on your investors now to fund it if you don't have a big
Oh,
reserve
wow.
fund. And a lot of the mistakes that people make, especially and this came up at the conference too, and I noted it because I made this mistake when I started out. A lot of new operators are really worried about the returns that they're providing for their investors, and they're really worried about like the rate, you know, raising enough money. They don't raise a reserve fund, right? So because they're so concerned about the return, and if, you know, they add another $500,000 to this raise, it's going to drop the returns by half a point, and then nobody's going to want to invest, and blah blah blah. And they're not really seeing the long term here, that they need a reserve fund, but also investors are not really going to like make a decision on your deal because of like the return overall is a couple of points different, right? What they want is certainty and to get paid and get their money back, right? So,
Right.
but you'll see a lot of new operators who are in that situation where they now have their bank accounts have been taken over by the bank. The bank is only paying them a small amount of money, you know, their basically budgeted amount to operate the asset. Anything, they have no reserve fund. So they're kind of in a, you know, if anything comes up, they're kind of screwed, right? And so that's, you know, that's another way where that's different in commercial because, like I said, they're paying their debt, but they're still in technical default, right?
Yeah.
So,
This is going to be interesting, folks. This is the opportunity to go out, network, add to your skills. I suggest following Jonathan Twomley. He does have a free PDF of how to do this. Jonathan, where can people find you and find that PDF?
yeah, so the PDF is at apartmentinvestorsclub.com, and you should please come and join my Facebook group, which is Apartment Investors Club on Facebook. And if you would like to invest with me, just Google Two Bridges Asset Management LLC and just sign up on the investor page.
Jonathan, thank you so much.
Awesome.